In this video, I'll go over investment strategies that I wish I knew before I lost a lot of my hard-earned money. When I started my investing journey, I was like everyone else. I was looking for the best investment portfolio, like the kind that gets you rich while you sleep. I had the basic idea, like buy and hold, pick cheap stocks, go for the easy stuff. But when I tried to build my own perfect investment plan, I got super confused. I looked everywhere, read all the books, watched every videos, and even asked Google. And then guess what happened? I got even more confused because there are so many ideas. Warren Buffett's 2-fund portfolio is all you need, but then John Bogle comes and says, not 2, you need 3. But then Ray Dalio comes in and says, forget about all of those, you need all-weather portfolio. At one point, I realized that I had a better chance of meeting Moses than finding my perfect investment plan, because it just doesn't exist. If someone comes and tells you that they have the best investment plan for you, they're definitely selling something. The truth is that nobody has the best investment strategies that they would know which portfolio would be the top dog in the future. Of course, there are some who make smart moves by diversifying their investments, but predicting the best one? That's just impossible, but that's what makes it exciting. So in this video, I'll go over 8 strategies that I wish I would have learned sooner. By the end of the video, you will have an idea of the strategies before you start your investing journey, so you don't have to learn the hard way like the way I did. The one fund wonder. Anyone would want to have their money grow in a simple way. For instance, you can just buy one stock for the rest of your life, which will grow without having any issue or volatility. That would have been perfect. Like Tesla. No, that just never happens. Tesla is a great company and it's a great stock if you trade their options and take advantage of the volatility, which is a completely different animal and needs its own video. Simple way that you can grow your money, invest into something like S&P 500 index funds or a total stock market index. S&P 500 is a shining team of 500 of the top biggest companies in the United States. It's like the best player from all different sports forming a super team. And when this team does well, everyone who invests in this does well. The total stock market index fund is even bigger team. It includes thousands of US companies, both big and small, form a team. And when the companies forming this team does well, so does the people who invest in it. Now, let me show you. As of November 30, 2023, S&P 500 index had a yearly growth of 20.80%. That's pretty impressive if you ask me. Over the 10 years, it's been growing at an average rate of 11.82% per year. Imagine your piggy bank getting bigger and bigger each year. The issue with that is it's a bit of a roller coaster. So when you're young, say in your 20s and 30s, it's fun. But when you're getting closer to your retirement, it might feel kind of weird. So if you're starting now in your 20s or 30s, go ahead, get started and have fun. But if you're looking for a little bit more security, check out number 2. Hi, my name is Tasvir Mirza. I'm a realtor and a diversified investor, and on this channel, I make finance videos with a strategy. Feel free to jump around the timestamp below for each strategy, and while you're down there, as it helps the channel and videos like this tremendously. A 2-fund investment strategy is a step up from having just one fund. You diversify just a tiny bit your investment with a mix of stocks and bonds. Imagine building a portfolio with Vanguard funds. You put your good chunk into Vanguard Total Stock Market Index Fund, ticker VTSAX, and some of the Total Bond Market Index Fund, known as VBTLX. The 2-fund strategy is all about balancing risk and simplicity. Just 2 levers to pull, stocks and bonds. It's slightly less risky than 1-fund portfolio, but still keeps things straightforward. Even Warren Buffett is into this approach. For his wife's trust, 90% in a low-cost S&P 500 index fund and 10% in short-term government bonds. Now, if you don't want Warren Buffett's investment strategy, you may be looking for a little bit more diversified portfolio. Here's 3 Amigos. And who are they? Just the 2 from the previous strategy, US bonds and stocks, but with this, we're gonna add the international stocks. So the team would be US bonds, US stocks, and international stocks. Why the 3, you ask? It's all about playing it smart and simple. We're not here to reinvent the wheel or outsmart the market. We're just here to ride the wave. A simple way of doing this is just buy US stock, which is one of our star player. Let's have 60% of them. Then let's get 20% of solid, dependable US bonds and 20% of global flair with the international stocks. Now, here's the thing. Some sensational content creators will tell you that US dollar is going down, China is taking over, the US economy is collapsing, we're all doomed. Relax. It's not happening what you think is going to happen. US dollar and US economy is still strong enough not to collapse like a house of cards, which I covered in this video and made some of the viewers think that I get paid from some think tank. which clearly is not the case as of now. The question is, if I'm so confident about the US economy and US dollar, why do I think that international stocks would be a great option to include since US companies already play in the global field? Because it's all about diversification. As confident as I am, there still may be a possibility that the market would go down, and you never know which market will shine and when. It's all about hedging against the risk. It's an intriguing strategy, especially with the debates all around it, because only a tiny fraction of the stocks actually drive the big wins in the market. And the fun fact? US market hasn't always been the top dog. There has been times when the global portfolio outperformed the US only ones. It's all a cycle, so you just have to play all the cards. Let me know in the comment section below, where do you think the US economy is heading? But if you think that's not enough to play it safe, here's 4 for more. If you think that the stocks and bonds are not safe enough diversification for investment, I present you real estate. It's a mix of different fund with a little extra focus on real estate. Why? It's not just because real estate is sexy, because hey, it is. It's actually a great diversity for your investment. So if you were to build a portfolio beside US stocks, bonds, and international stocks, you would add Vanguard's Real Estate Index Fund, V&Q, on top of it. Now, the Real Estate Investment Trust, or REITs, are super cool because they let you invest in real estate without the hassle of buying or selling and managing the property. Some people, if you're like me, loves it, but I understand that some of you just want to keep it simple and don't want to deal with the hassle of actual factual property. For them, this is extremely good option. But if you think that investing takes a lot of brain power, the next strategy is literally called the no-brainer portfolio. Bill Bernstein. This guy literally has a PhD in chemistry and also a neurologist, and he has written a lot of books about finances. If someone has the right to talk about no-brainer portfolio, there's no other guy better than him. His portfolio is pretty simple and well diversified. It's spread to multiple areas like bonds, European stocks, US small stocks, and S&P 500. It's based on loads of research and historical data aiming to perform well in the long run. So if you're using Vanguard funds, it would be like 25% in the Vanguard's total bond market fund, 25% in the Vanguard European Stock Index Fund, 25% in the Vanguard Small Cap Index Fund, and finally 25% in the Vanguard 500 Index Fund. You would agree that this is indeed a no-brainer portfolio. Just 4 funds that covers a lot of ground. It's got S&P 500, the bonds, which are pretty solid choice. Now, you may not want to even use 1% of your brain power, but just use the momentum of growth of a company and ride the wave. For you, it's the next step. Growth and momentum investing. And speaking of growth and momentum, I see over 90% of my viewers are not my subscriber. I have a goal to grow this community 1,000 strong by the end of the year, and I need your help with that. Consider joining the community by clicking the subscribe button below. Now, this is actually kind of riskier than any other options that we just talked about. Reason being, the higher income potential often comes with increased amount of risk. This strategy is strictly focused on stocks that are anticipated to grow compared to others. It's all about spotting stocks that have a potential to grow. Warren Buffett invests in companies for the long haul, as opposed to what will happen the next year. Him and his partner, Charlie Munger, rest in peace, never based their decisions on economic predictions. They focused on how well they think that the business will do over time. No, not all companies are as loyal as dogs, and if you're looking for a more loyal investment option, here are the dogs of Dow. If a company has an excellent reputation and shows sustained growth, and a large number of investors has interest in these, Dow Jones adds them. In 2023, the dogs of Dow includes the companies like Verizon, 3M, Dow Corporation, Chevron, IBM, and Coca-Cola. Strategy is simple. Invest in the top high dividend yield stocks in the Dow Jones Industrial Average. It's relatively easy to understand and implement, and it actually makes a good option for all the beginners. However, it requires a significant initial investment. And finally, if you have limited capital, the next strategy is for you. Any of the strategies I just mentioned may not be a good option for you. Your investment strategy is something that works for you, and it's based on your financial situation and your financial goal. The dollar cost averaging strategy is simply investing a fixed sum of money on a regular intervals regardless of the market condition. It can be done by stocks or bonds, but it's most effective with ETFs. The key advantage here is that you buy more shares when prices are low and fewer when prices are high. It will average out your investment cost over time. This is one of the best approach and suitable for long-term investments, as it mitigates a lot of risk associated with the market condition and the market timing. The worst thing you can do is timing the market. You want to learn more about high dividend paying ETFs? You should definitely watch this video here. Thank you for hanging out with me. Consider liking and subscribing. See you in the next video.